Welcome, everyone, to the Planet MicroCap Showcase Virtual 2022. I'm your host, Robert Kraft, and now presenting at our event is Richard Kellum, President and CEO of Data Communications Management. It's a publicly traded company. I got two symbols for you, DCMDF on the OTCQX and DCM on the TSX. Richard, take it away.
Thank you, Robert. Happy to tell the DCM story to investors today. And this is what we're going to review on my sort of 20 or 25 minutes. I'll try to spin the deck pretty quickly and take any questions after. So really, who is DCM? What's our strategic direction? So where are we going as a company? Importantly, how we're performing, and share some pretty exceptional performance that we're delivering this year. And finally, why invest in DCM? Okay, a little bit about who, before we get into who DCM is, just I will be making some forward-looking statements, so please, take that into consideration, prior to trading, okay? Thank you. So who is DCM? We are a company that helps large enterprises, large corporations kind of simplify their marketing communication workflow, okay? And I'll give you a few examples of that as we get into the deck here. And just talking about, what clients we work with. Just go to the next slide, James. We're working with 70 of the top largest corporations in Canada, 3 of the 5 largest federal government agencies. We've been around for north of 60 years, about 64 years. And we're pretty sizable and significant in the communication space in Canada with just north of 260 million in revenue. Quick look at our client list, or quick look at our locations first, then our client list. We've got locations across Canada. Most of these locations have kind of physical printing assets, and I'll give an example of that when I talk about some examples of product and use cases we deliver to clients, but we're kind of well presented across Canada. A little bit of representation in the US, but 95% of our business is Canadian based. Quick look at the client list. As I said, we're working with kind of north of 70% of large corporations in Canada, 70 of the top 100 corporations. And we're highly diversified across a multiple number of verticals. You can see 8 verticals here on this slide. And there's not a single client that is more than 7%-8% of our revenue. So a lot of diversification between clients and between verticals. Our strategic direction. If we just flip to the next page, James, I'll explain this. So we, again, for 64 years, we've been a company that's been helping simplify complex communication, mostly on the print side. So, and when I talk about highly complex communication, think of highly individualized and personalized communication, personalized print, principally, over the last 40 years, or last 64 years. And when I talk about that, think of anything that is kind of high SKU and low volume per SKU, right? Statements, direct mail, right? Identified direct mail would be a couple of examples. And a lot of that complex print that we deliver is enabled through a platform we started building about 25 years ago, but really tuned it over the last 7 or 8 years. We call DCM Flex. And that enables and automates a lot of that complex communication flow. Again, mostly into print, some now moving into digital, including social. So that technology platform that we've created allows for that flow. I'll talk a little bit more detail on the next slide. And then we're standing up another business, which is a pure SaaS business to help clients manage their digital assets. And we call that platform Assemble. And essentially think of, digital assets are being created in today's world. Advertising assets, communication assets, there's a lot of assets that are being created. There's got to be a preferred way to manage those, given the volume that clients are creating in today's world. And SharePoint, Dropbox, WeTransfer, et cetera, can handle the amount of volume and the need to be able to manage those assets. That's essentially what this digital asset management platform will do. Okay. So again, I'll talk a little bit more detail on this. So if we look at our 260 million in revenue, And we break our business apart in those kind of three areas: conventional print, what we call tech-enabled workflow, so print that actually is delivered with technology, or communications delivered with technology. And then our pure SaaS. This is our split in today's world. About 67% of our businesses we call, that complex print. About 31% of that total communication volume or communication workflow is tech-enabled. Generally, that's a higher margin and higher retention business because our technology is embedded into our clients' technology or digital stacks and digital ecosystems. And then about 2% of that $260 million is from technology fees. So service that we deliver, or the DCM Flex platform. So paying for that access to that platform, and other digital services we're providing to clients. And our strategy is super clear. We want to grow our total business between 5 and 10% over the next 5 years. And a big part of that growth will be by driving penetration of our digital platform. So moving from 31 or 32% of our revenue tech-enabled to north of 75%. And then growing those digital fees. So fees for using our technology, as well as the pure SaaS play that we're delivering with our digital asset management solution called Assemble. So really, think of our business as a kind of a conventional communication business, and pivoting that more into a digital and marketing workflow business. And we've certainly had success, given 31, 32% of our business today is already enabled with technology. Okay, so that's a little bit on strategy. 5-year financial objectives, growth between 5 and 10%. We actually put this out to the street around a year ago, and you'll see how we're performing against these metrics today. We can easily see a path to 35 to 40% gross margin. We're around 31% today. SG&A, we're continuing to operate at ZOG, we call it, so zero overhead growth, and that'll put us into the 18 to 20% SG&A range. Our EBITDA plan is to get in that 18 to 25 range, and obviously with a gross margin of 35 to 40, with an SG&A of 18 to 20, and with a revenue growth north of 5%, we can easily see that range in sight. And then our leverage, we're continuing to deleverage, will be less than 1 through the next couple of years, in the next 5 years. A lot of growth will obviously come from our base business, but significant improvement in our MarTech growth. And then those MarTech solutions obviously have a very high gross margin of north of 80%. Okay, so those are our 5-year objectives. And how are we performing? So a quick look at how we're performing on a year-to-date basis. We certainly have great momentum in our business. I'll explain in the next few slides here. I'm very pleased to report that we're kind of exceeding any goals that we put to the street over the last year. So just looking at our momentum from a revenue standpoint, we just released our last quarter a few weeks ago, and revenue in that quarter was north of 11%. On a year-to-date basis, we're 15.1% growth. So, I gave you that range of 5 to 10, so we're well north of that range. And it puts us on a TTM basis of just over 11%, 11.3% on a trailing 12 months. So good, solid revenue momentum in our business right now. And happy to report that our gross profit is growing faster than our revenue. So therefore, our gross margin obviously is improving. And you can see these numbers: 15.8% growth in gross profit on the quarter, 17.1 year to date, and 17.3 on a TTM basis. So good, solid momentum, building a better business while we build a bigger business as well. Looking at our net income, again, very, very positive growth in net income. We haven't had any restructuring this year. I'll talk that when I look at EBITDA, and that's obviously delivering to solid net income. The work has been done over the last few years, building a better business and really kind of restructuring. Now it's a time to build that bigger business, and we're seeing that the results in the bigger business, and obviously the results flowing through to net income. And then, if you look at the bottom net income on a TTM basis, we're 24.1. You'll see that, move up to triple digits as we exit out of Q4. We still have Q4 in our base from last year. And then you can see the strong EBITDA numbers in the quarter, year to date, north of 34%, and approaching 20% growth in EBITDA. And that is clean EBITDA. So we don't have, our EBITDA and adjusted EBITDA is absolutely the same because we've had zero restructuring. We made a commitment to have zero restructuring this year, and we certainly delivered on that commitment. Okay, so good, kind of healthy business. We'll look at that in the next few slides here from a quarterly basis, and kind of where we're trending on the year and what we expect through Q4. You see natural kind of growth through each quarter. And the next slide, James. 3 quarters of gross profit continue to grow and continue to grow faster than revenue, even despite some of the headwinds we've experienced from raw materials. We've managed to offset that by really managing, effectively our costs and our cost controls and our pricing. And then if we look at quick SG&A, if you look at the bar chart on the far right, draw your attention to that first. You can see that we're growing our revenue per associate. And our objective is to get north of 300,000. We're getting close to that now. SG&A, again, our commitment 18 to 20. You can see that we're down 1.1 points year to date at 21.1. So we're coming close to range. Expenses up slightly, but obviously, our metric really is a percent of revenue, and you can see we're at negative overhead growth as a percent of revenue, and kind of modest increase in SG&A. Some of that is due to the platform development on Assemble. So our people costs are actually kind of well in control and at or below a year ago. Okay. We have, as I said, really clean EBITDA momentum, and you can see that through each quarter. And as I said, our EBITDA and adjusted EBITDA are exactly the same. So really kind of no adjustments in EBITDA. So we're proud of those accomplishments this year. And then we continue to pay down debt. If you look at our term debt, it's kind of 2 stories here, right? Our term debt, you can see we've dropped significantly from 34.1 million at the start of the year down to 25.1 mil, and we'll exit obviously lower than that once we close out Q4. Our revolver is up a bit, and really that is due to just raw material, the raw material market. I think it's interesting. I think any supply chain in any industry has been disrupted. It's certainly been disrupted in our industry. We used to receive paper the day we needed it, sort of arrive in the morning and put it on the press in the afternoon. And now we're having to buy about 3 months out just to make sure we've got the inventory to meet the supply or to meet the demand that we've gotten. And that's obviously created a bit of more need for working capital. We'll see that reduce as we move through Q4, and we're expecting some correction in raw material supply chain as we get into 2023 as well. Okay. But certainly proud of the continued reduction in fixed term debt. We've been really building a solid growth muscle as a company, north of $30 million on a year-to-date basis in new business, and across all verticals, and many companies obviously across multiple verticals. So lots of diversification in the business wins. Okay, and proud of what we're doing from an ESG perspective. I won't go through a lot of detail. Probably just point out the one thing we're very proud of: our number of trees we reforested. We reforest 100% of our paper use on behalf of clients, and we put north of 500,000 trees back in the ground on a year-to-date basis. So real proud of our whole reforestation effort, and we certainly got very good client momentum with that sustainability objective or sustainability effort. But lots of work obviously outside of that on social and governance as well. Why invest in DCM? Obviously, we've got a pretty attractive valuation. I think as of today, we're around 70 mil on a 34.2 million TTM. So you can see the opportunities or the value, possible value creations in the marketplace based on that current market cap, and we got solid cash flow. And as I said, we've right-sized our organization, and you can see the growth that we're delivering, and we're expecting obviously that and planning that for that growth to continue. And I'm not going to spend a lot of time on this. You can see, what our exit plan is on debt this year, around 21 mil. You see our plans for 2023, and we're going to continue to accelerate that debt repayment curve over the next couple of years. And finally, I think we're really well positioned for digital acceleration for these three reasons. Think of us as a great business, right, with fantastic client list, incredible capabilities, and very solid cash flow to fund that digital acceleration. So very different, than a startup that needs to move to the capital markets to raise. We've got a great business, as I said. A lot of clients, or a lot of startups that are moving into the MarTech marketing technology solution space don't have any clients. They've got to hire salespeople to go secure clients and drive client penetration. We've already got a great client roster, 60 salespeople across Canada. So and fantastic capabilities in digital. And as I said, we've got certainly positive cash flow to fund our growth as we accelerate that digital penetration. Okay, and a quick look at our capitalization, about 50, just north of 50%. We call insiders, and that 49.7%, mostly retail. A couple of smaller institutions, but mostly retail. Okay, but 50 million fully diluted shares outstanding. And that is it. And I guess now we're over to any questions, but thanks for the opportunity, and hopefully it's clear. We're certainly very excited about where we are at DCM, and importantly, where we're going in the future.
Thank you very much for your presentation here today at the Planet MicroCap Showcase Virtual 2022. I'd now like to introduce Paul Andriola from Small Cap Discoveries to conduct a short Q&A. With that, Paul, take it away.
As a percentage of revenue, which vertical is most popular right now, and which verticals would you like to see improvement in?
Yeah, I'm not going to give you the exact percentages, obviously, for competitive reasons, but our strongest vertical right now would be in the FI space. And we're working with all the major kind of financial institutions across Canada. And you think of FI, there's a lot of kind of highly individualized and personalized communication. And we obviously bring a lot of value in simplifying complexity for that vertical. We do quite a bit of work in retail, quite a bit of work in energy. Got a big business in not-for-profit as well. Again, kind of highly personalized outreach in NFP, because they're looking to fund, right, to raise fundraising. And a lot of that is kind of personalized communication. So those are kind of areas that we're very strong in. In fact, we've got good business across all 8 verticals as I presented. There's a couple of areas of opportunities for us. We don't do a lot in the consumer goods sector, consumer packaged goods. We see that as a growth opportunity. We don't do a ton in automotive. We see that as a big growth opportunity as well. So there's lots of new business opportunity for us, either within the verticals that we're in, expansion revenue within existing clients, new clients within existing verticals, and new vertical penetration. Those couple of verticals I mentioned, CPG as well as automotive, are a couple that we're spending some time in, have identified targets to go after.
On the growth strategy side of things, from what you can tell us, is the goal to continue to grow organically and expand into those other verticals that you are targeting, or are you looking at any strategic M&A?
Great question. We're always looking for opportunities that could be accretive, so strategic opportunities for us, and opportunities for us to accelerate our presence in digital. And if they're right, if they're a good fit for us. But right now we see opportunities to deliver the 5 to 10% growth organically.
Marketing tech industry has seen a lot of growth lately. What would you say is the number one mistake that some new entrants make? And is it something that DCM can take advantage of?
Yeah, so it's really interesting. And I was a marketer for many years in my career, and marketers love, we call them shiny new toys or shiny new pennies, right? Love new technology, and marketers have actually bought a lot of new marketing technology from companies that are building solutions to help them in whatever area of marketing technology required, right? Marketing simplification. But a lot of that stuff doesn't kind of fit together. So they have, they may have bought, marketers may have bought 5 or 6 different solutions to satisfy different needs. None of it connects, right? And they haven't, gotten the adoption in the organization because a lot of those platforms aren't talking to each other. So in today's world, most important thing is making sure that that your technology is used by connecting it to existing technology stacks or technology or digital platforms that the client is has already in their ecosystem. So our value, if you will, or our unique selling proposition for all clients we talk to is adoption. We're all about making sure that it's going to be a well adopted and driving that adoption by connecting our technology to an existing digital stack or existing digital technology. So that's I think some startups have kind of got the t-shirt where they've created something that hasn't been able to talk or hasn't been able to connect to other stuff. And many are starting to figure that out now through APIs and through other solutions that allow them to, kind of be integrated into the technology stack.
Okay, we're in tough markets. How do you handle the macro environment? What are you doing to handle that macro environment right now?
Yeah, I think you're referring to potential recessionary times. But if I back up from there a little bit, obviously we've gone through a pretty significant disruption in supply chain this year. And you've seen how we've managed through that very, very effectively, making sure we've got access to raw materials, making sure that we're recouping and recovering any raw material inflation, right? As we price that raw material out. Then in terms of the future, headwinds that we may be experiencing due to potential recession or reductions in clients' budgets, we see those as opportunities. We're a company that helps companies simplify their communication workflow. So we're a company that actually likes to take waste out. Okay, likes to help clients optimize their budgets, help them optimize their communication. So we're finding opportunities now with clients that are maybe using other services, whether they're kind of internal or external services as well, to help them simplify that complexity, take waste out, and we say do more with less. So we see recession, and we see this headwind as an opportunity for us, and you're seeing that, right? We're the number I put up earlier, $30 million in new business this year. A lot of that has come from helping clients kind of simplify their marketing communication and have the ability to do more with less.
Looking forward, in 2023, what sort of catalysts do you expect or should investors watch out for?
One is obviously continued strong revenue performance and strong gross margin performance, obviously attached to that revenue. So, good kind of healthy base. And the second will be our continued digital penetration. You'll see that accelerate a lot next year as we stand up our Assemble platform and we continue to drive penetration of our Flex platform. And then obviously, that commitment for us to continue to build a better and a bigger business, right? We're not, we've gone through a year with no restructuring. We don't anticipate any significant restructuring, as we progress into next year either. We've got a perfect footprint right now, and it's a matter of just accelerating and building a growth off that footprint. So I just say continuity of results. You see the 3 quarters that we put in, consistent, sequential, positive delivery quarter by quarter, and that's what we're committed to.
And what sort of corporate actions are you doing right now to execute on your business strategies going forward?
Well, we're certainly we've worked hard to deliver a sustainable growth muscle, and you're seeing that in our results today. So we like to say we dream about growth, and we talk about growth every single day. And the one thing about building a muscle is you can't let it atrophy, right? So you've got to work it every single day, and we're doing that as an organization. You're seeing that in our results. We focus hard on driving, we call expansion revenues within existing clients, because many clients aren't using our full suite of services, including our digital services, and then of course new business development as well. And I shared that number earlier, that $30 million in opportunities we've secured in the marketplace. So that's what we're that's what we're focused on as an organization. We've had a significant improvement in engagement across our workforce as we've built this better business and bigger business, and we're going to keep focused on winning in the marketplace. That's what we're there for, helping clients simplify their marketing communication, and help them manage through potentially challenging environment that they're experiencing. So that's what we're committed to, and that's what we're delivering.
And for full disclosure, we're not shareholders of Data Management Communications.
Thank you, Paul. Thank you, everyone. Thank you for the presentation. But I'd also like to thank everyone that is listening in and engaging and participating with this presentation today. And with that, have a great rest of your conference.